Hello traders and welcome to another video review. Today is Thursday, January 27th of 2022. Let's take a look at what is going on in the economic calendar for today. As you can see, not much has been published, not much data has been published during the overnight session. The London session seems to be quite empty as well. Today, the unemployment rate in Spain is being released, is scheduled for release at 9 a.m. and the market participants expect a drop from 14.6% to 14.2%. As we know, the EUR unemployment is still a big issue in Eurozone. On the other hand, the New York session is full of interesting data scheduled for release. We are going to start with the GDP of the US scheduled for release at 2:30. The fourth quarter GDP is expected to increase from 2.6% to 5.3%, 3% increase. So that's look very promising. So expectations are high. GDP price index for fourth quarter 6%. Durable goods orders are expected to drop for the month of December from 2.5% to minus 0.5%. Interesting. Unemployment claims for January are expected to decrease from 286,000 to 260,000, and continuing claims are expected to increase from 1,635,000 to 1,680,000. The last data are scheduled for 4 p.m. Pending home sales are expected to increase from minus 2.2% to minus 0.3%. So plenty of data for today during the New York session. However, let's take a look how market participants are digesting yesterday's FOMC interest rate decision and of course a press conference. The US dollar index is ripping higher. This is the macro view of the US dollar index. This recent drop is clearly in three waves towards 61% of the Fibonacci retracement and technical support at 94.71. As we spoke about it many times, we have breakout above 95.50 and now we are already trading above 96.61, the 96.92, the highs from the end of the November 2021 are in view, and those highs looks like they are about to be tested and possibly even violated. So momentum is backing up this rally here, and right now, after the short period of consolidation around the level of 50, the momentum is at the level of 63 points. Strong increasing momentum backing up this recent move in the US dollar index. So dollar is the king across the boards, mostly because Fed is expecting a rate hike, announced even a rate hike in March 2022, and the market participants are expecting 4 rate hikes altogether in 2022. So it's better to buy cheaper dollar now than later. As you can see, the correlation is still active. US dollar index is ripping higher. Euro dollar is approaching the lows of the again the November, and then we have 1.1167, 1.1153 technical support level, key long-term technical support level. This is the support from 2020. Any violation of this zone would likely means that the road towards 1.10 and then towards the lows of the COVID decline at 1.0646, 1.0638 is open. So please keep an eye on the current market reaction on this zone This zone here, 1.1167, 1.1153, any violation, any big breakout to the downside is very negative for bulls. Momentum decreasing significantly. What is gold doing? The spot gold market is behaving just as expected. We have the top for the wave B, bearish engulfing pattern, A, B, C pattern here. It looks kind of a zigzag because 1, 2, 3, 4, 5 waves here, A, B, C to the downside, 1, 2, 3, 4, 5 waves here. And now we are decreasing. We are going lower towards $1,800 technical support, the key technical support, because it's very close to the short-term trend line support of this golden trend line here. Any violation of this trend line would mean we will follow the path of this this ABC wave progression. Apparently, if we take a look at the Fibonacci ratios on this sequence, the wave A measured from the wave B, the target for the wave C almost perfect. 100% is at 1,729. This is where we're going first, but we can easily extend towards 1,695, 1,689. So this is a $5, $6 Fibonacci cluster here, and if we will want bounce from 1,729, then we will hit this level for sure. So this is the current situation for the spot gold market. Gold is reacting very negatively on the FOMC news because the US dollar is rallying. US dollar is the king right now. So what is going on with the S&P 500 index? S&P 500 index is going lower as well because we got this hammer candlestick here. Then of course we got undecision, dodgy undecision pattern as well. Let me just zoom in. Yesterday initial reaction to the upside, then close below the open, so that's not good as well, but we are still inside of the gray area, and this gray area is still as ascending channel. However, today we opened exactly at the same levels that we closed yesterday. Please notice the fact that these levels here, 4,347, are the levels of extremely oversold market conditions on the daily time frame chart. We might expect a bounce, but in order to continue the move to the north, in order to continue the up move, the S&P 500 index must break above 4,488 and then 4,551, 4,598. Then eventually during the few next days, maybe by the end of the month, we can reach 4,817, right? If there is no breakout, especially above 4,488, this level, then of course that technical support, which is layered with three different levels, 4,300, 4,267, 4,234, might be violated, and then of course the market will drop more 300 points towards 4,084 points, and then towards 4,000 points. That correction in this, if this will happen, then that correction towards 4,000 points will have, I will tell you in a price range, will have around, I think it will be 20% or something like this. 17%, exactly 17% is a very nice big correction. And please remember that if we drop more than 20%, this means that the market is in the downtrend and the panic selling might happen. That correction is for sure the biggest correction in years since the COVID correction with 35%. So now even if we hit 4,000 points level, this correction is a half of the previous biggest correction. Okay, so that's not that bad at all yet. However, this is well almost 1 year, 10 months of the steady up move will be erased during this correction if there is a breakout below 4,300 towards 4,000 point. So please keep an eye on these three levels here. Keep an eye on them because those levels are the key levels to understand the market reaction on the FOMC. We should rally. We should rally towards March. If not, then of course the market will start to move lower, and that means the market will be pricing in the March interest rate hike by Fed. Okay, last but not least is of course Bitcoin. The Bitcoin didn't do well. The Bitcoin didn't do well, and it's very, very close to start another wave down, just as our scenario is showing. The key technical resistance, 39,540, basically $40,000, has not been violated. We got this pin bar here, and this pin bar, as you can see inside of the channel, is very bad indication of the bullish strength. That means the bears took the opportunity to sell the Bitcoins ahead of the key technical resistance. Let's put it here. Okay, this is the first level of technical resistance, around 39,540, around the $40,000, and now they are pushing it even lower towards the key technical support around, as you can see, 30,196, 28,964. If that level will not hold, then the bulls are in big trouble because market is back under the level of 30, which means the market is still in extremely oversold conditions. And if market stays too long in these extremely oversold conditions, the downtrend is easier to continue. Is easy to continue, and as you can see, we've been here below the level of 50 since the Christmas, basically since the Christmas period, over 1 month. So please pay attention to the current price action of the Bitcoin. We need to get out of this channel, break the level of 40,000, break the level of 41,188 and rally. If not, bulls are in deep trouble because this level here, this green level of 30,000, around 30,000, will be tested significantly for bullish strength. If the bulls fail, we are entering multi-year downtrend on Bitcoin. So let's see how market will play this scenario out. For now, this is everything from me. Thank you very much for watching this analysis, and I hope I see you guys tomorrow. So take care and bye bye.